On a cold Monday morning in January of 1979, a quiet transaction took place in the vaults beneath the Bank of England. No soldiers, no sirens, no television announcement. Yet in the course of a few hours, billions in wealth silently shifted from private hands into institutional control. This moment didn't ignite a revolution, but it exemplified the principle that has guided financial elites for more than a century. The architecture of money changes not through debate, but through design. Money does not collapse, it is replaced. And those who engineer the replacement decide who loses. Today, most people believe our monetary system is failing because of incompetence, corruption, or economic exhaustion. That's partially true, but incomplete. What is unfolding now is not accidental decay. It is the construction of a new model designed to unwind the liabilities of the old system while consolidating power into institutions capable of controlling the new one. To understand this, you must start with a concept richer than inflation, interest rates, or debt ceilings. It is the concept that defined the Great Depression, the collapse of Bretton Woods, and the birth of the dollar system we live in today. Monetary resets are not economic events, they are political decisions. Resets do not occur when a system fails. They occur when a system succeeds so completely that it becomes mathematically impossible to sustain. At that moment, the architects of the system choose not reform, but replacement. And replacement requires two ingredients: legal authority to redefine what money is, technical infrastructure to ensure citizens cannot escape the new system. In 1933, those tools were executive orders and federal agents seizing physical assets. In 1971, they were international agreements and televised announcements. In 2028, they will be software updates and digital conversion events. But the pattern, the transfer of purchasing power from distributed citizens to centralized institutions, will remain unchanged. Let me take you back to where this pattern began, not in 1933, but in 1913, when Congress passed the Federal Reserve Act. A bill designed, in its language, to stabilize the banking system, but engineered in practice to place the issuance of U.S. currency under private authority with public enforcement. This was the birth of a system where the expansion and contraction of money supply could occur without democratic input, a system in which the state became the enforcer, but not the architect, of monetary design. 2 decades later, that system faced a mathematical dilemma. The dollars in circulation were constrained by gold, and gold was held by citizens. For the Federal Reserve to expand credit, it required the legal permission to seize private assets and the moral justification of an economic emergency. The emergency arrived. The permission was granted. The gold was seized. What most people never learn in school is that the seizure itself was not the point. The seizure was merely the first stage of a mechanism designed to reprice gold upward without compensating citizens for the difference. This difference, the mathematical spread between confiscation value and revaluation value, became new institutional capital. Wealth didn't disappear. It didn't evaporate. It migrated. Fast forward nearly a century, and the mechanics have evolved, but the principle hasn't. Legal authority precedes economic action. Value transfer is disguised as policy, not theft. The winners are those positioned inside the new system before the conversion occurs. In 2020, governments didn't confiscate gold. They didn't need to. They simply expanded central bank balance sheets by nearly $10 trillion combined and allowed inflation to transfer purchasing power from wage earners and savers to asset holders and debtors. No police. No agents. No legal orders. Just mathematics. Citizens who held cash lost value. Institutions that held assets gained value. The mechanism didn't require force, only code. And this is where the 2028 reset enters the story. The monetary system built during the 1971 to 2020 era is reaching a critical boundary. Debt cannot be serviced, inflation cannot be controlled, and interest rates cannot normalize without collapsing the structure. When a system becomes mathematically unsustainable, policymakers must choose between two outcomes: default, reset. History shows they choose reset, not because it is moral, but because it is effective. Default destroys creditors. Reset rescues institutions. Default is chaotic. Reset is engineered. The reset being engineered for 2028 is not based on gold, oil, or debt monetization. It is based on digital currency conversion. And unlike 1933, this reset will not require physical confiscation. It will require only legal authority to redenominate currency, technical infrastructure to execute code, crisis narrative to justify emergency action, The legal authority already exists across global jurisdictions. The technical infrastructure is being installed through digital payment rails and central bank pilots. And the crisis narrative, whether economic, geopolitical, or cybernetic, will emerge as needed. Because the timing of resets is never accidental. They occur not when catastrophe strikes, but when the architects are prepared. Digital currency pilots in over 100 jurisdictions demonstrate something extraordinary. The capability not just to issue new money, but to convert existing balances into new units at programmable exchange rates. Imagine you wake up one morning to discover that your $100,000 in existing dollars has been converted into 70,000 new digital units, not because you spent money, but because the conversion rate was written into monetary policy. No agents at your door, no courts, no hearings, just numbers. People imagine the future of monetary policy as futuristic, frightening, dystopian. But the core mechanism is ancient. Devalue old units. Issue new units. Capture the spread. Call it stability. This is not theft. It is policy. It is legal. And it is mathematically efficient. Which is why central banks favor it. Because when a monetary system resets, 3 questions define the outcome. Who loses purchasing power? Who gains balance sheet capacity? Who controls the architecture afterward? In 1933, the answers were citizens, Federal Reserve, Treasury and banking system. In 2028, the answers may be digital currency holders, central banks and institutions integrated into CBDC rails, technocratic governance structures capable of algorithmic policy. Citizens believe technology will democratize money. Institutions are designing technology to control it. Every wallet, every payment, every unit of money programmable. Not private property, licensed participation. Money not as a bearer asset. Money as a behavioral mechanism. Not physical notes, but conditional digital permissions. And when the next crisis arrives, whether in 2026, 2027, or 2028, this architecture will activate, not to prevent collapse, but to enable conversion. A conversion designed not to save individuals, but to recapitalize institutions. Just as it did in 1933. Just as it did in 1971. Just as it did in 2020. Because history does not repeat. Systems repeat. Mathematics repeat. Incentives repeat. The faces change. The technology evolves. The outcome remains identical. Purchasing power flows upward. Control centralizes. Citizens comply. And the global reset begins. The transition from physical currency to digital architecture is often marketed as modernization, efficiency, or financial inclusion. But beneath the language of convenience lies a deeper structural objective: to replace a monetary system based on scarcity with one based on design. Scarcity, after all, restrains power. Design enables it. For most of human history, money was constrained by physical reality, metals, circulation, distance, time. Gold could be hoarded, silver could be hidden, banknotes could be stored, and coins could be transacted privately. In such a system, citizens possess 2 forms of wealth. The asset itself, the privacy of ownership. Digital architecture eliminates both. Under programmable currency, value exists only within a permission system, and transactions leave permanent identifiers. Wealth is no longer private property. It becomes an entry in a sovereign database. To see how revolutionary this is, you must understand the fundamental weakness of every monetary system prior to 2020. Central banks could issue currency, but they could not guarantee its movement. A central bank could create money, but it could not force you to spend it. It could tax you, but it could not reach into your account. It could devalue currency, but could not prevent you from escaping by holding cash. Programmable money solves these problems. Currency that expires can force spending. Currency that yields negative interest can penalize saving. Currency that is geofenced can restrict where is spent. Currency that requires digital identity can limit who is allowed to transact. And most importantly, currency that exists only as code cannot be withdrawn, hidden, or stored outside the system. The state no longer persuades behavior, it programs it. For those who believe that such tools would never be used in advanced democracies, history suggests otherwise. When central planners face unsustainable debt, their objective is not freedom, it is survival. And governments, unlike corporations or households, do not go bankrupt. They change the rules. Debt can be reduced through inflation, taxation, default, confiscation, or redenomination. Redenomination is the cleanest, is the most politically palatable, And in a digital system, it is the most efficient. Imagine you have $1 million in savings. Overnight, you receive notice that under the new digital currency framework, your assets will be converted at a ratio of 0.75 to 1. You now have $750,000 in new units. The remaining $250,000 has not evaporated. It has been captured by institutions to offset systemic debt. You suffered a haircut. The system gained solvency. The economy was stabilized. This is not science fiction. This is how monetary resets have occurred for centuries. Gold seizures, currency devaluations, debt restructuring, balance sheet recapitalization. The mechanics evolve, the logic does not. To see why the next reset is inevitable, not theoretical, examine the mathematics of the current system. The global economy functions on the basis of perpetual debt expansion. Governments borrow, central banks purchase debt, and new currency is created to service old liabilities. Interest payments are rolled forward through issuance, not earnings. The structure functions so long as growth exceeds interest. Debt issuance can be absorbed. Currency retains purchasing power. All three conditions are now breaking down. Global debt stands above $315 trillion, according to the Institute of International Finance. U.S. federal debt alone exceeds $36 trillion, with annual interest payments surpassing military spending. Europe remains trapped between recession and energy inflation. Japan survives only through central bank asset purchases. The mathematical consequence of this structure is clear. Governments cannot grow their way out. They cannot tax their way out. They cannot inflate their way out without destroying purchasing power so rapidly that political stability collapses. This leaves a singular viable mechanism, controlled redenomination of money. Redenomination is not default, but transformation. It converts a system that is insolvent under old rules into one that is solvent under new rules, not by increasing wealth, but by reassigning it. This is why central banks are not merely studying digital currencies, they are building infrastructure for systemic transition. The public thinks CBDCs will compete with crypto. They will not. Crypto competes with CBDCs. CBDCs compete with the entire dollar-based monetary regime. A citizen may move from Bitcoin to dollars. But when the system transitions, they will be moved from dollars to digital units. And in that moment, the essential question becomes, at what ratio? The answer depends not on markets, but on mathematics. If a digital currency is launched without redenomination, the system remains burdened by legacy liabilities. Banks remain encumbered, government debt remains unsustainable, and central banks remain trapped between inflation and contraction. Therefore, redenomination is almost certain. Not as punishment, but as balance sheet reconfiguration. A 10%, 20%, or 30% haircut on digital conversion would immediately shrink monetary liabilities across the system. It would reduce debt burdens, lower interest expenditures, and recapitalize central bank balance sheets. In exchange, citizens would receive a stable currency, resistant to inflation, backed by law, and integrated into a programmable economic architecture. A population facing declining purchasing power, collapsing pensions, and unstable markets may accept this arrangement not as theft, but as salvation. In 1933, citizens surrendered gold because they believed the alternative was collapse. In 2028, citizens may surrender purchasing power for the same reason. The public reaction is predictable because the psychological conditions are predictable. People fear sudden collapse, not gradual erosion. And policymakers understand that a controlled reset framed as rescue is preferable to an uncontrolled crisis framed as failure. But reset requires more than policy. It requires plumbing. The infrastructure necessary to convert billions of accounts cannot be improvised in an emergency. It must be engineered in advance, tested, refined, and deployed. And that is precisely what is happening. Instant settlement systems, digital identity frameworks, cross-border settlement networks, programmable transaction protocols, institutional wallet infrastructure. Every element required for seamless digital conversion is being built right now, not to enable convenience, but to enable transition. The plumbing of the next monetary system is already in place. The switch has not yet been flipped. When it is, billions of balances will migrate from legacy currency to digital units, and the mathematics of that conversion will determine who loses wealth and who acquires it. The process will not be visible. There will be no trucks of confiscated gold, no emergency press conferences, no dramatic collapse. One morning, balances will simply update. New units will appear. Old ones will be erased. And the world will accept it because resisting would mean losing access to the system entirely, a system in which money no longer exists outside institutional control. This is the global reset plan. Not collapse. Not revolution. Not chaos. Conversion. Engineered. Legal. Programmable. Inevitable. To understand how the 2028 reset will unfold, you must recognize a truth that most people never confront. Monetary systems do not change when citizens are ready. They change when institutions decide the cost of continuation exceeds the benefit of preservation. Public consent is not required. Public understanding is not required. Public participation is optional. In 1971, the world learned that lesson in real time. The international monetary system had been constructed around a promise: the US dollar would be convertible to gold at $35 per ounce. That promise was mathematically impossible by the late 1960s, but its fiction held global finance together. When the United States suspended convertibility, the world did not approve it, vote on it, or debate it. They woke up to a new reality, imposed from the top down. Critics predicted collapse. Instead, the system reset. Inflation soared in the 1970s. Debt expanded in the 1980s. Global reserves accumulated in the 1990s. The dollar did not become weaker. It became stronger, not because it retained value, but because it became the central mechanism of value creation. Under this system, wealth did not depend on the strength of currency. It depended on access to credit. And those with access to credit became the structural winners of the new era. The lesson: systemic winners are chosen by architecture, not merit. Which brings us to the current transition. The architecture of the dollar system is exhausted. Its mathematics are unsustainable. Its legitimacy is eroding. Yet it continues, not because it functions, but because there is no functional alternative. The next monetary system cannot emerge from ideology or political theory. It must emerge from infrastructure. And that infrastructure is digital. The architects of this system do not think in dollars or interest rates. They think in networks, data, friction, and control. The traditional constraints of monetary policy, physical currency, bank intermediaries, privacy of transactions, are inefficiencies. In the new model, money is not a medium of exchange. It is a programmable instrument of policy enforcement. This is the fundamental shift. Money will no longer be scarce. It will be conditional. Wealth will no longer be private. It will be permissioned. Value will no longer be stored. It will be allocated. Money will not function according to supply and demand, but according to algorithm and access. If this sounds abstract, consider how digital value works today. Your credit card functions only if the network approves each transaction. Your bank account is accessible only with institutional permission. Your online assets can be frozen, seized, or restricted remotely. You do not own digits in a database. You hold usage rights issued by an institution. The transition from legacy currency to digital currency is not a radical leap. It is the completion of a decades-long process. The difference is scale and precision. In the legacy system, money could be hidden. Assets could be stored privately. Value could remain outside institutions. In the digital system, value cannot exist outside network. Transactions cannot occur without authorization. Wealth cannot remain unobserved, unaccounted, or ungoverned. Programmable currency transforms financial freedom into compliance. Not because governments are malicious, but because systems that face existential threats optimize for survival, not principles. Consider the basic arithmetic of debt. Debt expands faster than productivity. Interest compounds faster than income. Liabilities grow faster than capacity to service. At some point, the math stops working. At that moment, policymakers face a binary choice. Allow collapse. Engineer transition. Collapse is political suicide. Transition is political salvation. But transition requires more than policy. It requires technology capable of enforcing new rules instantaneously and universally. Physical currency cannot do this. Commercial banks cannot do this. Legacy payment systems cannot do this. Programmable money can. Digital architecture allows changes to be instant, invisible, irreversible, universal. When redenomination occurs, it will not take place through public debate. It will occur through a software update. This is why central banks are not merely studying digital currency. They are creating interoperable platforms capable of updating every retail account simultaneously. This is not modernization. It is militarization of monetary policy. Imagine a global system where Every account exists on a unified ledger. Every transaction is tagged with identity. Every balance can be updated in real time. Every rule can be applied without appeal. Every violation can trigger automated enforcement. This is not a conspiracy. It is a design problem, one solved elegantly by digital systems. Once implemented, the system eliminates the core risks of legacy finance. Bank runs, cash hoarding, capital flight, tax leakage, underground markets. The public sees convenience. The system sees control. Because the most powerful form of control is not force, but dependency. If citizens depend on institutions for access to the monetary system, dissent becomes self-punishing. Speak against policy, lose access. Refuse compliance, lose funds. Operate outside the system, lose existence. Economists call this incentive alignment. Citizens call it coercion. Institutions call it efficiency. But what truly matters is this. A monetary system built on programmable currency cannot support economic freedom as we understand it. That freedom dies not through law, but through architecture. The shift to digital money is often framed as a battle between innovation and regulation, between decentralization and centralization. But the struggle is far simpler. A system based on permissionless value is incompatible with a system based on infinite liabilities. Bitcoins, stablecoins, decentralized finance, these are threats not because of ideology, but because they undermine the fundamental requirement of the next monetary system: perfect visibility and perfect enforceability. The institutions engineering the reset understand something most citizens do not. A monetary system with trillions in unserviceable liabilities cannot be preserved. It must be replaced. But a replacement cannot occur until every asset, every bank, every citizen, and every business is connected to a unified settlement architecture. Once that architecture exists, redenomination becomes a technical event, not a political one. The narrative will be predictable. Crisis emerges. Confidence collapses. Transition is proposed. Conversion is framed as rescue. Citizens exchange freedom for stability. Not because they are weak, but because the alternative is worse. A collapsing monetary system destroys everyone. A controlled reset destroys only savers. Citizens accept the constraint of digital architecture because they believe they are being saved from chaos. They seldom recognize that they are being saved from chaos engineered by the system itself. The tragedy is not that institutions act in their own interest. The tragedy is that citizens believe it is done for theirs. The new monetary system will not liberate. It will optimize. It will not empower. It will condition. It will not democratize. It will centralize. And its true power will not come from currency, but from the inability to step outside it. The future cost of non-compliance will not be imprisonment. It will be exclusion. A world where the only acceptable economic identity is one granted by institutions, and the only acceptable wealth is wealth that can be controlled. This is not dystopia. It is infrastructure. And it is almost complete. When people think of a global financial reset, they imagine a dramatic event: stock market collapse, currency hyperinflation, or sovereign default. They imagine panic, chaos, emergency broadcasts, and economic ruin. But this is a misconception. Resets are not explosions. They are migrations. The most successful monetary transitions in history have not occurred through force, but through administrative restructuring. Not by blowing up the system, but by migrating it into a new format. The public sees disaster as risk. Institutions see disaster as opportunity. This is why central planners prepare for crisis not by preventing it, but by designing the mechanism to capitalize on it. In 1933, the crisis justified confiscation. In 1971, the crisis justified revaluation. In 2008, the crisis justified monetization. In 2020, the crisis justified intervention. In 2028, the crisis will justify conversion. Because the true purpose of crisis in monetary architecture is not resolution, it is authorization. Crises grant permission for actions that would be politically impossible under normal conditions. Politicians rely on this dynamic. Central banks depend on it. Financial institutions weaponize it. The next crisis does not need to be catastrophic. It simply needs to create a narrative in which the status quo becomes unbearable and the alternative becomes inevitable. And when that moment arrives, governments will not propose austerity, reform, or liquidation. They will propose a new monetary system engineered to solve the problems that legacy systems cannot overcome: debt saturation, systemic fragility, and loss of policy control. They will frame it as innovation. They will market it as inclusion. They will sell it as fairness. They will defend it as stability. And citizens will accept it for one simple reason. The cost of rejection will be too high. The global reset is not about collapsing the old system. It is about transitioning to a system in which the architecture of money guarantees compliance. To achieve this, the new system must do three things: reduce legacy liabilities, restore institutional balance sheets, create mechanisms for ongoing behavioral control. The first two objectives can be achieved through redenomination. The third requires programmable currency. Most analysts focus on the first, debt reduction. But the third, control, is the central prize. Because programmable money is not simply a new currency, it is a new legal instrument. It transforms monetary policy from macroeconomic management into microeconomic enforcement. Think about how monetary policy works today. Central banks adjust rates. Banks adjust credit. Consumers adjust behavior. It is indirect, inefficient, and uncertain. A programmable system eliminates uncertainty. Instead of adjusting base rates, policymakers adjust spending at the individual level. Stimulus goes directly to wallets. Taxes are deducted automatically. Fees are applied instantly. Penalties are executed algorithmically. Transfers are restricted in real time. This is not policy. It is code. In a programmable economy, individuals do not react to monetary policy. They are written into it. The promise of CBDCs is efficiency. The function is enforcement. And enforcement requires visibility. This is why the architects of the next system are not building currency. They are building identity rails. Digital money cannot function without digital identity. Identity is not a feature of the system. It is the foundation. A system that knows who you are, what you earn, what you spend, where you spend, how often, with whom, and under what conditions your access to value should be permitted or denied. Not surveillance. Certification. Not control. Eligibility. Behavioral compliance disguised as consumer safety. The financial system will no longer enforce rules through courts and regulators. It will enforce them through code and networks. To function in the system, you must comply with its conditions. Not because you are compelled by law, but because you are conditioned by architecture. The most powerful mechanism of control in modern systems is not violence, it is exclusion. You can speak freely, but lose access to money. You can protest, but lose access to basic services. You can refuse compliance, but lose the ability to transact. The future punishment for dissent is not prison, it is economic invisibility. This is the true function of programmable money, to turn the right to transact into a conditional privilege. People assume this kind of power is impractical, dystopian, or totalitarian. But systems do not evolve based on morality. They evolve based on necessity. Governments cannot allow currency systems to function outside control when liabilities are infinite, debt is irreversible, and compliance is essential. Freedom is expensive. Control is efficient. The new monetary system will not ask for your trust. It will demand your participation. And participation will be mandatory, not because governments legislate it, but because institutions require it. Try to live outside a system where money, identity, and access are unified. Try to participate in society without digital credentials. Try to transact without approval. Opting out becomes impossible, not because you lack courage, but because you lack permission. This is why the future of monetary architecture is not national, it is global. A fragmented system cannot enforce behavioral standards universally. A unified system can. The global reset is not about creating a single currency. It is about creating harmonized infrastructure across all currencies, infrastructure capable of synchronized redenomination, cross-border enforcement, standardized surveillance, interoperable identity, real-time compliance. This is not fantasy. This is central bank policy. Read the white papers. Read the pilot programs. Read the statements from BIS, IMF, ECB, BOE, PBOC, and the Federal Reserve. They are not hiding their intent. They are documenting it. The future of money is account-based, identity-linked, programmable, expirable, traceable, enforceable. It can deny transactions automatically. It can restrict savings algorithmically. It can reprice value mathematically. And during a crisis, it can reset the system instantly. Resets that once required years, wars, legislation, or physical force will now occur through software updates applied across billions of accounts simultaneously. The day the reset occurs, the world will not wake up to collapse. The world will wake up to version 2.0 of money. Balances changed, terms updated, rules applied, and the narrative will be predictable. We prevented a depression. We stabilized the system. We saved your money. We protected the economy. Just as in 1933, people will surrender wealth not because they are forced, but because they believe it is necessary. And institutions will capture value not because they are evil, but because the system demands it. The greatest misunderstanding in economics is the belief that systems evolve for moral reasons. They evolve for mathematical ones. A monetary architecture built on unsustainable liabilities must reinvent itself, not by solving problems, but by redefining them. And those who control the definition control the outcome. The global reset is not coming. It is being engineered. The only remaining question is not if, not when, but who will benefit from the transition and who will pay for it. History provides the answer. Those who hold assets in the legacy system will lose. Those who control architecture in the new system will win. Those who understand the transition may adapt. Those who ignore it will not be consulted. The next monetary era will not reward savers. It will not reward independence. It will not reward privacy. It will reward alignment with system incentives. Because in the new monetary world, wealth is not earned, stored, or owned. It is allocated, because in the new monetary era, wealth will not be a possession, it will be a permission. And those permissions will be granted by institutions that do not ask what you want, but demand what you will accept. The global reset isn't a prediction. It is a transition already underway. As this story continues to unfold, you will face a choice. Understand the structure of the system before it changes, or wake up inside a system in which your consent is assumed. If you want to stay ahead of the reset, the engineering, and the economics shaping your future, make sure you subscribe. Because the next chapter won't just change money, it will change you.